Welcome to the deep dive. This is where we take, a whole pile of research reports, articles, and really try to unpack the core insights, the stuff that actually matters. We want to get you up to speed, make it interesting.
And hopefully compelling, too.
Exactly. So today, we're sort of pushing past the usual suspects,
Mhm.
When you think about booming Asian economies, maybe China comes to mind first, Japan, South Korea.
Or the classic Asian tigers,
Yeah.
Singapore, Taiwan, that kind of thing.
Right. But there's another major player, one that's been making some serious waves, maybe a bit more quietly, but profoundly reshaping global manufacturing and trade.
Yeah, it's not just like a minor adjustment. It's a fundamental transformation we're talking about. This country has really strategically placed itself right at the center of how global supply chains are evolving.
That's a great way to put it, a fundamental transformation. So our mission today is to dive deep into this detailed report from a major financial institution. We're focusing on the really remarkable rise and the future prospects of Vietnam's manufacturing sector.
We're going to unpack how they did it, how Vietnam went from, well, frankly, a less developed economy facing huge challenges after decades of conflict.
To being this dynamic, really influential player on the world stage. We'll kick things off with the Doi Moi reforms. That was the spark, really.
The absolute foundation.
Then we'll look at the two big engines, foreign investment, massive amounts of it, and their very strategic approach to global trade.
And how they deliberately shifted their whole economy towards manufacturing, optimizing.
Optimized, yeah.
And finally, we'll examine its role now, which is critical,
Yeah.
especially in this shifting global order, navigating the complex relationship between the U.S. and China.
It's a fascinating story, honestly. Lots of surprising turns.
It really is. So get ready for a pretty insightful journey, I think, into one of the world's most compelling economic stories right now. Okay, so let's start right at the beginning, Genesis, you could say. This policy, Doi Moi, it didn't just tweak things, it fundamentally rewrote Vietnam's economic future. Absolutely. It kicked off in 1986 at the 6th National Congress of the Vietnamese Communist Party. And you've got to understand, this wasn't some, minor policy shift,
No, it was pretty radical, right? It had this dual focus, economic and ideological opening.
which for a communist state at that time, ideological opening, that's a huge deal. It signaled a real willingness to embrace market ideas, new ways of engaging, things that were, completely different from their old central planning model.
It felt like a recognition, didn't it, that the old way just wasn't working, wasn't delivering for their people.
Exactly. And what's really interesting about Doi Moi, right from the start, was this core principle they talked about, tackling economic and social inequality, integrating fairness.
So not just growth for growth's sake.
Precisely. It wasn't just about chasing GDP numbers, which, you see in some other development models. They explicitly committed to ensuring the benefits would spread, uplift the population, address those existing disparities.
Like a kind of social contract for the reforms.
You can definitely see it that way. It helped build public buy-in for what were, let's face it, revolutionary changes. This focus on equity alongside efficiency, it kind of sets Vietnam's path apart, trying to balance market dynamism with socialist ideals of well-being, a unique hybrid.
And the immediate economic results. Were they visible quickly?
Oh, absolutely. Profound is the right word. Between 1988 and 1999, so that first decade or so, Vietnam's average actual GDP growth hit about 7.2%.
Okay, 7.2%. How does that compare?
Well, put it this way. During that same period, other emerging and developing economies globally, they were averaging around 3.7%.
So Vietnam was basically doubling their pace.
Pretty much, doubling it. This wasn't just a blip, it was sustained high-speed growth that signaled something really different was happening.
Yeah.
That 7.2% average year after year, it compounds. It means pulling millions out of poverty, new businesses starting, building that essential economic foundation, infrastructure,
Yeah.
skills, production capacity.
Like an engine suddenly roaring to life.
Exactly, accelerating way past its peers.
And did that momentum last into the 2000s?
Remarkably, yes. Even with a more complex global economy, from 2000 to 2024, the average actual GDP growth stayed incredibly high at 6.4%.
Still beating the averages.
Significantly. Emerging and developing economies averaged 5.2% in that period, and the global average is only 3.5%. So yeah, still way ahead. Maintaining that kind of pace for nearly a quarter century through global shocks and all, That shows real economic resilience.
Serious underlying strength.
Absolutely. And if you look at the very latest figures, for 2024, actual GDP growth was 7.1%.
Wow, still that high.
Still that high. Again, much better than the global average of 3.3% or the emerging market average of 4.3%. It really speaks volumes about their long-term strategy, their adaptability. They're not just growing, they're growing strategically.
And that kind of sustained growth, it must translate into a huge overall increase in the size of the economy, right?
Massive. This is where the scale becomes really clear. Vietnam's GDP was tiny in 1990, less than $10 billion, like the size of a small city's economy.
Right.
By 2024, it had exploded to approximately $460 billion.
$460 billion from under 10.
Yep, that's more than a 50-fold increase in just over 3 decades. 50 times bigger.
It's hard to even picture that kind of scale up. Imagine your local town's economy growing 50 times. The roads, the power, the factories.
Everything. It implies this colossal amount of construction, new businesses, millions of jobs, a complete transformation of the landscape and people's lives.
And how does that look on the world stage? Has its global share increased proportionally?
It has. Its share of global GDP went from less than 0.05% in 1990, basically negligible, to over 0.4% in 2024.
So still small in the grand scheme, but a huge jump, relatively speaking.
Exactly, an 8-fold increase in its global economic footprint. It means Vietnam's a much bigger player now in international discussions, in trade, as an investment destination. Its economic weight is definitely being felt more.
But you mentioned earlier it wasn't just about the numbers, it was about fairness, about people's lives. How did that play out?
That's the human side, and it's just as dramatic. Before Doi Moi, per capita GDP was really low, under $1,000. That means widespread poverty, limited opportunities for most people.
A tough starting point.
Very. But with the reforms, with liberalization, it started climbing fast. It crossed that $1,000 mark in 2007, which is often seen as a key turning point for developing countries. Better living standards start becoming noticeable then.
And since 2007?
It just kept accelerating. By 2024, per capita GDP was over $4,500.
That's a huge leap. From under $1,000 to over $4,500.
It really is. It translates directly into millions moving out of extreme poverty into the middle class.
Yep.
Better education, better healthcare, more consumer goods, paved roads, better homes. You see it everywhere. That's the real measure of Doi Moi's success.
And what do the projections look like going forward? Does the IMF see this continuing?
They do. The IMF's forecast from April 2025 projects Vietnam's per capita GDP will surpass $6,000 by 2030.
Another big jump.
Yeah. It shows continued confidence from major institutions in their trajectory. It points towards, ongoing improvements in quality of life, deeper integration into the global consumer economy. It's a powerful indicator of real human progress.
Okay, so that foundational growth is staggering. But how? What were the mechanics? You mentioned foreign investment being a key engine. How did they attract so much FDI?
Well, they didn't just hope for it. They actively courted it. Strategically, through legislation. It started really early with the Foreign Investment Law back in December 1987.
Just a year after Doi Moi. That's fast.
Incredibly fast. It was a clear signal. We want foreign capital. And crucially, they didn't just set it and forget it. They kept tweaking it. In 90 and 91, they eased restrictions, cut bureaucracy.
Making it easier for companies to come in.
Exactly. Then a really big step was the 2006 Vietnam Investment Law. That was groundbreaking because it unified the rules for domestic and foreign investors, removed a lot of the old limits on foreign ownership.
Leveling the playing field, essentially.
Right. A very clear signal of commitment to an open, integrated economy. And they kept going. Another big law in 2015 further simplified approvals, cut red tape, enhanced incentives.
So a continuous process of improvement, making it more and more attractive over time.
Absolutely. Removing barriers, step by step. Learning, adapting, staying competitive for that global capital.
And the results? Did the money flow in?
Like a floodgate opened. Before Doi Moi, FDI flow was basically zero. Imagine that. And then boom. From just $4 million in 1989, it shot up to $2.4 billion by 1996.
Wait, $4 million to $2.4 billion in 7 years.
A 600-fold increase. Staggering. And its share of global FDI flow went from near zero to 0.6%. International investors were clearly seeing the opportunity.
Okay, that's explosive early growth. Was there another big jump later?
Yes, 2007 was absolutely pivotal. So you had that new unified investment law we just talked about.
Right.
And Vietnam joined the World Trade Organization, the WTO, after 12 long years of negotiations.
That's a powerful combination. Domestic legal certainty plus global market access.
Exactly, a double whammy. And the impact was immediate. FDI flow that year skyrocketed to around $7 billion. That's a 190.9% increase just from 2006.
Wow. Almost tripled in 1 year.
It put Vietnam firmly on the map as a top-tier investment destination. A new era, really.
Did that momentum continue after 2007?
It did. FDI flow passed $10 billion in 2015, and by 2023 it hit $18.5 billion. Vietnam's global share reached 1.4%. It shows sustained, long-term confidence from investors through thick and thin globally.
So it wasn't just a temporary surge.
No, it became a consistent, deeply rooted trend. Investors see it as a reliable, improving environment for the long haul.
So all this money flowing in,
Yeah.
what did it actually build? Where did the FDI go?
A huge chunk went into what economists call fixed asset formation. Basically, the physical building blocks. Factories, machinery, infrastructure like power grids, roads, ports.
The tangible stuff.
Exactly. Before Doi Moi, FDI contributed almost nothing to this. Vietnam was building with its own limited funds. But after Doi Moi, FDI's share of fixed capital formation jumped from just 0.5% in 1989 to over 21% in 1990. It peaked at nearly 50%, 49.2% in 1994.
So at one point, almost half of all new factories, equipment, infrastructure was being funded by foreign investment.
Correct. And even after that peak, it stayed really significant, averaging over 15% between 2009 and 2022. In 2022, it was still 13.8%.
How does that compare globally?
Much higher. The world average in 2022 was 5.0%. Developed economies averaged 2.8%. Developing economies 7.3%. So Vietnam's 13.8% clearly shows how absolutely central FDI has been in literally building its modern industrial base.
Providing the physical capacity for everything else.
Precisely. It shaped the physical reality of their economy.
So it's not just the annual flow, but the accumulated investment that's significant. How deeply embedded is FDI now?
Extremely. A key measure is the FDI stock relative to GDP. That's the total accumulated foreign investment over time compared to the size of the economy. In 2022, that ratio hit 51.5%.
Over half.
Over half. And it had been above 50% for 3 years running. That means the value of all foreign-owned assets and operations is more than half the size of Vietnam's entire annual economic output.
That's an incredible level of integration.
It really is. Much higher than the global average of 44% or the developing economy average of 37.7%. It tells you foreign companies play this hugely outsized role in production, employment, everything.
And the annual flow compared to GDP?
It was 4.3% in 2022, and it's been consistently over 4% for years. Again, higher than the 2.4% for developing economies.
Wow.
All these numbers just reinforce how FDI isn't just a boost. It's woven into the very fabric of Vietnam's economy, a fundamental driver.
Okay, engine number 2, foreign trade. You said Vietnam was very strategic here, not just passive.
Absolutely. Super strategic, proactive, and persistent. They actively chased integration. That 12-year slog to join the WTO in 2007, that shows incredible commitment to playing by global rules and opening up.
A decade of aligning laws, regulations.
Yeah.
That's serious effort.
It really is. And WTO membership wasn't the end goal. It was a launch pad. They then went on this blitz, signing free trade agreements, FTAs, and economic partnership agreements, EPAs, left, right, and center.
Like what?
Started with the Asian-China FTA in 2003. Then later, deals with the Eurasian Economic Union, VN-EU FTA, the Big Pacific Rim Deal, CPTPP, a crucial one with the European Union, EVFTA, and the massive Regional Comprehensive Economic Partnership, RCEP.
So connecting with Asia, Europe, the Pacific, pretty much everywhere.
Exactly. Each agreement meant more market access, lower tariffs, deeper economic ties, building this intricate web to make Vietnam a central hub.
And what did this do to their trade volume? Did it explode like the FDI?
Absolutely. Before Doi Moi, total trade was tiny, under $3 billion a year. Then it took off, passing $10 billion by 1995. And between 1987 and 2006, the average annual growth rate was over 19%.
19% growth per year for almost 2 decades.
Sustained, rapid expansion, integrating fast.
And did WTO entry provide another boost?
Massive. The year they joined, 2007, trade volume jumped past $100 billion. Just shows the immediate benefit of that deeper integration. And it kept climbing. By 2024, it was approaching $800 billion.
$800 billion in trade. That's immense.
It is. The average growth rate was still around 14% a year from 2007 to 2024. It cements their status as a major global trading powerhouse.
And their share of global trade, did that grow too?
Yep, from basically 0 to 1.6%. But here's an interesting detail. About 0.4 percentage points of that increase happened after 2017.
Why then specifically?
It suggests they were really starting to capitalize on shifting global dynamics around that time, maybe already positioning themselves for the supply chain changes that were coming, especially involving the U.S. and China. Shows agility.
That makes sense. Now, one key indicator for a trading nation is its trade balance deficit or surplus. How did Vietnam fare there?
That's a really pivotal part of the story. For a long time, especially pre-WTO, Vietnam ran a persistent trade deficit. They just weren't producing enough domestically and had to import a lot.
Relying on others.
Right. But as they integrated into the WTO, and critically, as all that FDI boosted their own production capacity, things started to change. They could make more stuff, both for themselves and to export.
So imports became less necessary and exports grew.
Exactly. And the big turning point was 2012. That year, they achieved their first trade surplus since 1992, a huge milestone.
And deficit to surplus.
And it wasn't a one-off. By 2024, the trade surplus was $24.2 billion. That was the second year in a row with a surplus over $20 billion. It's a clear sign of their growing manufacturing and export strength.
Now, you hear about countries being trade dependent, but Vietnam seems like an extreme case. How big is trade relative to its GDP?
Extraordinary is the word. After Doi Moi, the trade-to-GDP ratio didn't just rise, it surged instantly from maybe 10% to over 50%.
Wow, overnight becoming an economy where trade is half the output.
And it kept climbing. It peaked at an unbelievable 180.6% in 2021. Even after settling slightly, it was still 158% in 2023.
158%, how is that even possible?
It means for every dollar of value created within Vietnam, more than $1.50 worth of goods crosses its borders, either coming in or going out. It's like its economic bloodstream is almost entirely global commerce.
How does that compare to other countries, even trade-focused ones?
It puts Vietnam right at the top globally. The world average is about 45%, China 33%, India 31%, Brazil 27%. Even other big Southeast Asian traders like Thailand, 112%, Malaysia 145%, Cambodia 111% are significantly lower.
So trade isn't just important for Vietnam, it's the defining feature.
Absolutely. It defines a whole economic model. Deeply integrated, highly sensitive to global demand and supply.
And naturally, this focus translates into massive exports.
Immense export growth. Their share of global commodity exports went from near zero to 1.7%, and the export-to-GDP ratio from under 5% before reforms to around 90% recently.
90%, so almost all economic activity is linked to export.
In a fundamental way, yes, it's a pure export-driven growth model, producing goods primarily for the world, not just for themselves.
Okay, so all this investment, all this trade, it must have fundamentally reshaped the structure of Vietnam's economy, right? Not just grown it.
Completely reshaped it, deliberately, through what's called industrial structure optimization. Before Doi Moi, Vietnam looked like many less developed countries, very agrarian.
Dominated by farming, fishing, forestry.
Exactly. That primary sector was over 40% of GDP. Industry and construction were under 30%, services under 40%. A typical rural, less industrialized base.
Ripe for change, though.
Definitely. And Doi Moi ignited that change rapidly. The secondary sector, industry, construction, and tertiary services started booming. The speed was remarkable. By 1992, services overtook the primary sector's share of GDP.
Just 6 years in.
And 2 years later, in 1994, the secondary sector also surpassed the primary. Critical milestones showing that shift away from agriculture towards industry and services. A reallocation of resources, labor, capital.
And what does it look like today, that structural shift?
The transformation is stark. The 2023 figures show services at 43.0%, industry and construction strong at 37.0%, and agriculture, forestry, fisheries down to a historic low of just 12.0%.
So definitively a modern, industrializing, service-oriented economy now.
Unquestionably. It's a hallmark of successful development.
Within that big industrial sector, what's been the main driver? Is it all manufacturing?
Manufacturing has been the clear dominant force. Even before they joined the WTO, manufacturing was already about half of that secondary sector.
Okay, already important.
But post-WTO, its growth accelerated even more. Its share within the secondary sector consistently went above 60% and is now stabilized around 65%.
So industry in Vietnam really means manufacturing for the most part.
To a very large extent, yes. It shows this deliberate choice, this strategic focus on industrial output as the core engine.
And how has that impacted manufacturing's share of the overall economy, the total GDP?
Steadily growing. You saw a big jump after WTO accession. By 2023, manufacturing's share of total GDP reached 23.9%.
24%. How does that compare globally?
significantly higher. The world average is around 15%. So Vietnam's 23.9% really underscores manufacturing's central role. It's not just part of their economy, it's defining its character and trajectory. And if you follow the money, follow the investment, it tells the same story. Manufacturing has consistently been the core target, both for domestic and foreign capital.
So Vietnamese companies are investing heavily in manufacturing too.
Yes, there was a clear acceleration in manufacturing investment scale after WTO accession. Its share of total national investment rose from under 20% to nearly 30% at one point, and it's stable now around 25%.
A quarter of all investment going into manufacturing. That's significant.
Very significant, and it dwarfs other sectors. In 2023, manufacturing got 24.4% of investment, the next highest. Transport and warehousing at 13.9%.
Right.
Everything else was under 10%.
Wow. It really highlights the national priority. This is where they see the future.
Unambiguously. And foreign investors. Their preference for manufacturing is even more pronounced. It's almost their sole focus.
Really? How much of the FDI goes there?
Look at 2024. Total registered FDI was about $38.2 billion. Of that, $25.6 billion went straight into manufacturing.
That's doing the math. Like
Yeah.
2/3.
Exactly. 66.9%. And it's been over 60% for 3 years running. Compare that to real estate, the second highest, which got 16.5%. Everything else, less than 5%.
So foreign companies coming to Vietnam are overwhelmingly coming to manufacture things.
Overwhelmingly. It speaks volumes about the perceived stability, profitability, and strategic importance of Vietnam's manufacturing base for global corporations. They're placing their biggest bets there.
And the logical outcome of all this investment focus is?
Absolute dominance in exports. It's fundamentally changed what Vietnam sells to the world. Before 2000, manufactured goods were important, but less than half of exports.
Okay.
Post-2000, as manufacturing developed, that share climbed above 50%. Then after the WTO jump, another big leap. By 2022, manufactured goods were 85.6% of commodity exports.
85%.
And it's been over 80% for 8 straight years. It's a total transformation from exporting mostly agriculture or raw materials to being a specialized, focused manufacturing exporter. When you see made in Vietnam, it's almost certainly a manufactured product now. And what's really crucial here is that they're not just making more stuff, they're making better stuff. They're climbing the value chain.
Okay, what does that look like in practice, moving beyond basic goods?
Exactly. Think back to the early 2000s. Primary products, raw stuff, were over 50% of exports. Manufactured goods were only about 40%, typical for a less industrialized economy.
Right.
But as manufacturing developed, especially post-WTO, the share of manufactured goods just kept climbing. Past primary products in 2005, a key moment, then kept rising 60%, 70%, 80% after 2008. By 2023, 83% of exports were industrial manufactured goods.
So for nearly a decade, over 80% of their exports have been manufactured goods. That's a profound structural shift.
It really is. From resource reliance to industrial output, adding value.
Is there another dimension to this upgrading, like moving from simple assembly to more complex products?
Yes, definitely. We can see that in the rise of capital-intensive products versus labor-intensive ones. Labor-intensive goods like basic apparel, simple assembly, they've stayed pretty stable, around 40% of exports.
Yeah.
That's kind of their foundation, providing jobs.
Okay, the base level.
But alongside that, you see the rise of capital-intensive goods. These need more sophisticated machinery, more tech, more skilled labor.
So higher value stuff.
Generally, yes. They started small, maybe 10% of exports in 2000, creeping up to 15% by 2007-ish. But after WTO entry, accelerated growth. Capital-intensive goods actually overtook labor-intensive ones in 2016.
Really?
Yeah, and now they consistently make up over 50% of total exports.
So that's a clear signal they're moving beyond just cheap labor assembly.
Absolutely. It shows a growing capacity for more sophisticated production, higher value goods. Moving up the ladder, it's not just about volume anymore, it's about increasing the complexity and technology in their exports.
Can you give some concrete examples? Which sectors show this leadership?
Sure, look at textiles and apparel. Highly competitive global market. Back in 2007, pre-WTO, Vietnam had maybe 1.3% global share, ranked about 15th.
Okay. Decent, but not top tier.
Right. By 2023, exports over $40 billion, global share 4.9%. That put them 4th globally.
4th. That's huge. Up there with...
Comparable to Germany and Italy, only China is significantly bigger. It shows incredible scale, efficiency, quality in a tough industry.
What about footwear? Another traditional strength.
Similar story. Steady growth after Doi Moi, then significant acceleration after WTO. Went from under 5% global share to over 10%. By 2023, they were securely the world's second largest footwear exporter.
Second only to China.
Second only to China with 13.2% global share. All other countries were below 10%. Shows consistent, high-volume, quality production, an indispensable part of the global footwear supply chain for major brands.
Okay, textiles, footwear, those are maybe more traditional. What about higher tech areas, electronics?
That's perhaps the most telling sign of their upgrading. Before WTO, electronics are only about 5% of exports, minor. But from 2012 onwards, it changed dramatically. Strategic shift, big investments. By 2023, electronics, computers, and parts hit a record 16.2% of total exports, driven by major foreign electronics firms setting up shop there.
So building complex tech products now.
And exporting them at scale. Get this, Vietnam is now the world's fifth largest exporter of electrical machinery and electrical products.
Fifth. Who's ahead of them?
Only China, the US, Germany, and South Korea. That's elite company.
Wow. That really demonstrates capability in advanced manufacturing. Complex assembly, high-value goods.
Exactly. It shows they've moved way beyond being just a low-cost labor hub. They're a key player in the global tech supply chain now, a testament to their industrial transformation.
So putting it all together, the growth, the upgrading, the trade integration, where does this leave Vietnam now in this, shifting global order? What are its core strengths moving forward?
Well, a fundamental advantage, one we keep coming back to, is the labor force, specifically cost effectiveness. The average after-tax monthly salary as of mid-2025 was around $430.
$430 a month. How low is that globally?
Puts them in the bottom 25%. Compare that to the U.S., over $4,300. Germany, UK, over $3,000. It's even significantly lower than China these days.
So that low labor cost is still a major draw.
A crucial foundation. It allows companies to scale up manufacturing cost effectively, stay competitive. It's a powerful magnet for investment, especially in labor-intensive parts of production.
And it's not just cost, right? You mentioned demographics earlier, the demographic dividend.
Exactly. Vietnam still benefits hugely from this. Yes, the share of workers over 50 has increased a bit to about 26.7% in 2022, which is normal aging. But the core working age population, 25 to 49, that golden age group, it's consistently stayed over 60%.
A strong core workforce.
Very strong. And if you add the 15, 24-year-olds, the incoming workers, the total golden labor force is over 70%. That ensures this continuous supply of people for manufacturing growth for years to come.
How does that compare to neighbors like China? Are they aging faster?
Vietnam's population is aging much more slowly. The share of people 65 plus is still under 10%. China's was over 14% in 2023, and aging is becoming a real economic challenge there. So Vietnam has this stable, relatively young workforce, a huge long-term asset.
Okay, labor cost and demographics. What else? Geography must play a role.
A massive role. Its location is incredibly strategic. That long coastline along the South China Sea, it perfectly connects major markets, China, Southeast Asia, but also acts as a bridge to Europe and the Americas.
A natural trade hub.
A natural crossroads. And it's boosted by multiple deepwater ports along that coast. Haiphong, Da Nang, Ho Chi Minh City. These are critical for efficient logistics.
Making it easier to get materials in and finished goods out.
Exactly. Cuts transport costs, shipping times, simplifies supply chains, a huge competitive edge for global manufacturing and distribution.
So strong natural advantages. Is the government just relying on those, or are they actively pushing things forward with policy?
Oh, they're very proactive. Forward-looking policies are key. They have things like the National Strategy for the Fourth Industrial Revolution by 2030.
Okay, what's that about? AI, robotics.
Pretty much. Leveraging those new technologies, developing innovative solutions, updating their growth model, pushing digital economic development. It's about moving up the value chain, not just relying on current strength.
Ambitious.
And there's more. The National Master Plan for 2021-2030 and Vision to 2050. This envisions Vietnam becoming a leading developed industrialized nation in Asia, a regional financial center, even a leader in high-value ecological agriculture.
So a very broad, long-term vision.
Right. These aren't just wish lists. They provide a strategic roadmap. They signal where resources will go, what industries they want to attract, how they plan to foster innovation. This combination of natural advantages and proactive strategy is a powerful competitive edge.
Now, let's get into the really complex part, how Vietnam is navigating the shifting dynamics between the U.S. and China. This seems crucial to its current position.
It's absolutely central. And it's evolved. Back in the early 2000s, Vietnam's main export markets were regional Japan and China.
Makes sense. Close neighbors.
But as Vietnam's manufacturing muscle grew, making more sophisticated goods, the U.S. market became increasingly important. By 2002, the U.S. had already overtaken Japan as Vietnam's single largest export market. Its share jumped from maybe 5% to around 20%.
So an early strategic shift towards Western markets.
Driven by their growing capabilities, they could meet the demand and quality standards. It foreshadowed what was to come.
And then came the U.S.-China trade friction around 2018. How did that impact Vietnam?
It was like pouring gasoline on an already growing fire.
Right.
Companies worldwide, facing tariffs and uncertainty, scrambled to diversify supply chains away from China.
Looking for alternatives.
And Vietnam was perfectly positioned. Existing infrastructure, competitive labor, those trade agreements, it became the go-to alternative for many.
You can see that in the numbers.
Starkly. By 2024, the U.S. share of Vietnam's exports hit 29.5%. That's up about 10 percentage points from just 2017, before the trade war really bit.
A massive, rapid acceleration. So Vietnam directly benefited from companies de-risking from China.
Hugely. Became a key alternative manufacturing hub.
What did this do to the trade balance between Vietnam and the U.S.?
It caused Vietnam's trade surplus with the U.S. to explode. It was already growing after WTO entry, past $10 billion in 2010. But post-2018, it went from over $30 billion to over $100 billion.
Over $100 billion surplus with the U.S.
By 2024, it was $104.4 billion. That's a $70 billion increase just since 2017. It vividly shows Vietnam's pivotal role in absorbing the production shifts caused by trade tensions. A huge chunk of demand is now flowing through Vietnam.
Okay, so the U.S. is the dominant destination for finished goods, but what about the relationship with China? Is Vietnam decoupling from China?
Not at all.
Yeah.
That's the crucial complexity here. While the U.S. buys the most finished goods, Vietnam's manufacturing itself remains deeply, intimately reliant on China.
Reliant how? As a market or
As a supplier, China is Vietnam's second biggest export market. Yes, about 15%. But critically, China has been Vietnam's #1 import source since 2003. And that dependence has actually deepened since 2018.
deepened, even with the trade war.
Yes. China's share of Vietnam's imports reached almost 38%, 37.8% in 2024. That's over 10 percentage points higher than in 2017.
So while Vietnam exports finished goods to the U.S., it's importing more and more components and materials from China to make those goods.
Precisely. That's the hidden interdependence. The smartphone assembled in Vietnam and sold in the U.S. It's likely full of components made in China. Vietnam acts as this vital processing and assembly hub, using its labor and trade deals, but it's still deeply plugged into the broader East Asian manufacturing network, with China as the key supplier.
So it's not really Vietnam replacing China.
No, it's more like Vietnam becoming a critical node within a reconfigured chain. It's a boat-hand situation, not either. It assembles goods, often using Chinese inputs, for export to the West.
That makes its position really unique and maybe quite powerful.
Increasingly important and definitely nuanced. It's bridging different parts of the global manufacturing ecosystem. It shows how future supply chains might be more complex and interwoven, defying simple ideas of complete decoupling. Vietnam's ability to manage both relationships is key to its success.
Okay, so looking to the future, where does Vietnam go from here? You mentioned it's still relatively low on the value chain in some ways, reliant on imports.
Right. There's still a journey ahead in terms of capturing more value, moving beyond assembly into more design, R&D, high-tech component manufacturing itself. That's the next big step.
But its strategic position seems secure, even growing.
Absolutely. Especially with ongoing trade shocks and the push for diversification.
Yeah.
Vietnam isn't just reacting. It seems poised to strengthen ties, especially regionally, including with China, and play an even bigger role.
How might that strengthening of ties look, particularly with China?
Well, China's Community of Shared Future initiatives are a big factor here. They aim for deeper regional cooperation and integration. A major policy conference in April 2025 noted China reached consensus on this, with 17 neighbors forming clusters.
And Vietnam is in one of those clusters.
Centrally located in the Indochina Peninsula cluster. This implies potential for more formalized collaboration, massive infrastructure projects perhaps, aligned development goals. It could really anchor Vietnam's regional role.
Is the relationship really that positive?
The official statements emphasize that China's relations with its neighbors are, quote, at their best period in modern history. That signals intense cooperation and trust building are priorities. For Vietnam, this could mean benefiting from concerted regional development efforts.
Is this collaboration already happening in practice?
Very much so. In 2025, there were deep exchanges across many sectors: trade, infrastructure, energy, finance, even intellectual property, leading to tangible cooperation. It shows a strong mutual commitment to deepen ties beyond just buying and selling.
Where are the biggest opportunities for deeper economic ties between Vietnam and China specifically?
From a trade perspective, Vietnam relies heavily on China for computers, electrical equipment, and mechanical equipment. Those make up 44% of its imports from China.
So the machinery and tech needed for Vietnam's own factories?
Exactly. As Vietnam's manufacturing grows, its need for these inputs will likely increase, offering huge scope for deeper integration. Other promising areas are textiles, steel, phones, plastics, chemicals, areas where the economies complement each other.
So the relationship is set to become even more intricate and interdependent.
It seems highly likely, solidifying Vietnam's crucial role in both regional and global supply chains.
Okay, let's try and wrap this all up. It's been a fascinating deep dive. We've traced Vietnam's incredible transformation, kicking off with those Doi Moi reforms back in '86.
Which unleashed decades of stunning growth, a 50-fold GDP increase, and real improvements in living standards.
We saw how massive foreign investment and strategic global trade integration turned it into one of the world's most trade-dependent economies.
And crucially, how it didn't just grow, it upgraded. Manufacturing became dominant, attracting huge investment.
Climbing the value chain, becoming a leader in textiles, footwear, even electronics.
Right, showcasing advanced manufacturing capabilities.
Then they looked at its unique strategic position today, navigating those complex U.S.-China dynamics.
Leveraging its advantages, labor, geography, policy to thrive amidst global shifts, becoming a key beneficiary of supply chain diversification while still deeply linked to China.
It really is a compelling case study, isn't it? Rapid development through global integration, even with geopolitical headwinds.
A testament to deliberate policy, outward focus, and an adaptable workforce, reinventing itself on the world stage.
So here's something for you, our listener, to think about. Given Vietnam's rise, its deep integration with both Western markets and China's supply chain, its ambitions, what unexpected consequences could this have for global supply chains, for trade patterns over the next decade?
Will it accelerate diversification? Or will its unique both-hand approach become a new model? What new collaborations or competitions might emerge?
Lots to ponder. But as always, there are risks, right?
Absolutely. And the sources highlight this. Profound changes in trade rules, geopolitics, technology, they could always alter the trajectory. Historical trends aren't guarantees. The global economy is dynamic, unpredictable.
A crucial reminder, nothing is set in stone.
Constant adaptation is key.
Indeed. Well, the deep dive continues for all of us as these stories unfold. We'll be back soon with another stack of sources to unpack for you.